All right. Hey, everyone. Good morning. Welcome and thank you for taking the time to join as always. If you're new to this, what I typically do is put the mute button on in the background so that that we don't get any distractions from background noise, because most people will watch this later on video as they go through their day. But if you do have questions, don't just use the chat function and we'll do our best to see it and try to get it answered. So with that, I'm going to jump right in and start talking. So yesterday, lots of volatility in these markets, right? And there's a pretty obvious blame for that, which would be the missile that was fired or landed in the Polish territories. And there's been a lot of debate overnight as to who was responsible. Was it Russia that launched it? Was it did Russia launch it at Poland? Did they launch it at the Ukraine? Did the Ukraine try to shoot it down and miss, and that's what actually landed over in Poland? And if you really read through all the different news sources, you're going to find information every direction. I mean, the theories and the conspiracies and they're all over the map. And so I think it's safest to say we don't know. We don't know for fact what has occurred over there, and we don't know why we have deaths inside the Polish territory, but we know that we do. So now the question is how will these markets respond, right? They initially responded very bullishly right out of the top, and started to accelerate higher, and that lasted, I'm going to say, less than 15 minutes before they immediately started getting sold. And you'll see that action, especially on the corn candlestick chart here in a minute. And then overnight, we've taken off 100% of any premium that was put on yesterday, and actually started working lower in the wheat market, implying that that there is more security in the world food situation than maybe that traders had thought. And underlying that are rumors out of Russia and Ukraine this morning that the grain talks are going well, that the grain corridor will stay open and will be extended, and that in exchange for allowing food to flow, Russia is going to get access to their pipeline to transport ammonia through Russia and into the Ukraine. That's going to net Russia billions of dollars in revenue, and net the Ukraine, 1 or 2% of the value coming back into Russia. And furthermore, Russia wants to be added back into the banking SWIFT system. So basically, Russia wants to continue doing business as usual in its with the world, with no repercussion for its actions, and wants to go ahead and take its piece of Ukraine as well. So we'll see if our world leaders decide that that's worth it or not, and we'll just sit back and let it unfold. But this stuff can change on a dime, right? We saw it yesterday. We see it periodically where news headlines flash and all of a sudden short covering comes in, because the people that are short the market are scared of those headlines and have to cover quickly, and the people that are long the market are either very, very nervous about it, or they're hesitant to be buyers because of the headline risk as well. And then beyond that, if you just isolate the war issues in the Ukraine, there seems to be this consensus among analysts, and I think it's weighing on the market pretty heavily, that there is plenty of food. Russia's got lots of wheat. South America's going to grow great crops. Australia's got a lot of wheat. We have a good crop. Nothing to see here. All is good. And our exports are down, and it's well known that we're going into a recession or even a depression, and the Feds are going to keep raising interest rates, and the dollar's going to keep going up forever, and our food is going to get cheaper and cheaper in the world, and nobody wants it. So we've got to go lower. There seems to be this underpinned just just universal agreement that that's what it is, and that there has to be some sort of major catalyst that will drive these markets higher. And we seem to be discounting weather in Argentina. We seem to be discounting the fact that the crops have not been harvested or brought in South America. We seem to be discounting the fact that China continues to manipulate the numbers because their balance sheets just don't add up. It just makes no sense that they can have the population that they have, the needs that they have, the usage that they have, and not have imported any grain, or not nearly as much as they should have. It just makes no sense that they have ample supplies. So there's a lot going on in these markets, and there's lots of different activity or lots of different inputs that can cause extreme market activity and push these things rapidly one way or the other. So it's really, really tough. And what you end up seeing are charts that look like this. So I've started here with soybeans because, you know, soybeans aren't grown in Russia and Ukraine. So their price action shouldn't have anything to do with what's going on over there. But we seem to react just as swiftly in the bean market as we do the corn and wheat markets. But if you just isolate bean fundamentals, you know, what do we have? We have a very tight balance sheet of 220 million bushels. We have domestic crush that is at all-time records that are overwhelmingly profitable margins at these levels, and we have a building demand base with the biofuels mandates that are coming out. So the need for bean acreage continues to increase relative to anything else, and so you keep seeing beans being supported, and we are selling some. Although I get it, the sales have been under what would be normal. But you have to wonder, why are we sitting at these levels? And then on the other hand, if we're that bullish from a crush standpoint, and we're that bullish from a future demand standpoint, then why have we not been able to break this trend line as we've been sitting here consolidating up against it for you know, how many days is this? 10? We've just been consolidating at it. Now, beans have been sideways, and we're trading the exact same level we were trading effectively back in June. We have gone nowhere, and we've gone $1.50 either side of nowhere since. So this market has frustrated people. It's chopped a lot of people up, and it's been very, very painful to trade. But what follows a period of long consolidation is always a period of expansion. And the tighter that this coil continues to get, the more likely that the bigger that expansion will likely be, and the more extreme price reaction we'll have to it. And at this point, I don't think you can guess whether we're going to break out of the top side or the downside. I think you have to just look at the top of this line. You got to expect a move above it, a throwback to it before you move higher, or you have to just be willing to sell against this low right here and sell it as we fall back down below out of this cloud, and assume that you're going to break out the bottom side of it. Because if we do snap a trend line to this low right here, up to, and we'll add, because this connects with lots of points. Whenever you're drawing a trend line, you want to connect with as many points as you possibly can. So if you have a little through over, that's fine. But if we consolidate this into this wedge, you can see what's likely to happen if we continue to fail here, and we really take this low out. I think we got to head down and test the bottom of it. And if we do break below 14, you know, I think you've got to look all the way down to 13, 1298, maybe lower if you do break that down. And so I don't know what the catalyst will be for that. It could be that corn is going to roll over here. So we've talked about corn a lot, and we've talked about the difficulty in the last 60 days of determining whether this sideways action is consolidation after this up move, or if this whole move from the July low over is consolidation after this big down move. And what we know is that consolidation favors continuation. So it's kind of important to know whether we're consolidating after the sideways move or after the down move, right? And it's really, really difficult to distinguish that because these moves were so big, and that's why it's taken so much time for us to digest it. Big moves take time to digest in the market, and so you've got to let that happen. Now, last week we talked about the Fibonacci relationships between these moves. So, and whenever you see an overlap or multiple Fibonacci targets hit at once, then what you'll end up seeing is, or what you'll end up with a lot of times, is a powerful reaction. So corn yesterday was really interesting because before the news hit, we were actually trading above Monday's high and above Friday's high before that news hit at 662. So whatever the news was, it didn't hit until after we had already started to lay the foundation of this bear trap. And you can see that on the 1 hour and 4 hour charts, but I'm not going to get down in there. And when it also reversed right at this 38.2% retracement of this move from the July low to this high right here, this marked the 38.2 retracement on December corn. Now, the other thing that overlapped is that this decay, this wave down from 7 down to 651, is almost an exact 1.5 times the distance of the decay from here. So you have an A, a B, and a C right down into the 38.2 and 1.5 move, which is an overlapping Fibonacci support level, coupled with this support that held back here, and we started to reverse this market and get bought. Now, today's action isn't surprising yet, and I think it calls into question the low that's right here at 652. If we can hold above that and reverse from here and work higher, then I think we've got a shot to work back up into the 680 level and back into this consolidation area. And then the market's going to have some major decisions to make about which direction it really wants to go. Now, the overnight action here doesn't really concern me very much because it's been on mediocre volume, it's overnight, and there's been a lot of headlines designed to try to push this market one way or the other. So I think you have to assume that this is just noise, and that the by 12 o'clock, by today's close, we'll know a lot more. And we could be way down here, we could be way back up here, we could just trade sideways. I don't know. I think a sideways trade is more bullish than bearish today. The only thing that I don't like about yesterday's action is the quick selling that hit immediately on this rally up. I mean, it didn't last more than, I don't know, 10, 15 minutes. I mean, it just got sold very, very quickly. And I don't know if that was algorithms or if that was headlines. I don't know what it was that caused the selling, but then we did find some support, and overnight, it is what it is. So I think we're in a really big day today on corn. I think it's going to be really important. I think sideways to higher is what we're looking for, and we're looking for this low to hold between 650 and 655. And if it doesn't, then I think that's evidence that this entire sideways move, or this entire move here, is corrective from the summer lows, and we need to sell it because we're going to come challenge these lows and make new ones and bring in these targets that we've laid out before, all the way down at 5 and all the way down at 470. So big move coming from this point right in here, in our opinion, is what we should expect to happen, and we just need a catalyst or the market to give us some clarity as to which direction it wants to go. So for today, we're leaning to the bull side. I think uncertainty favors premium. I think the weather in Argentina is not good, and I think that the demand numbers are. I think that the demand is stronger than what is currently be reflecting in the exports. Remember, we haven't been able to move bushels off the river very well, and then because of the river flows. And then the last thing I want to talk about on corn before I switch to wheat here are the spreads. So if we look at December to March here, okay, this is the December minus the March. If you look at this spread, what you've seen is a massive rally in the last several days, darn near to an inverted market. Full carry on this spread is really no more than about 10. So we've been trading at between 50 and 70% carry, which would be a normal oversupplied market, until the last few days when we've started to push higher. And there are certainly people that are more that are better experts at this than what I am. But from my understanding is that with the river situation that we've got, the market, the basis has been doing some heavy lifting to pull bushels from the east to the west to satisfy our deficit here. But what it hasn't done yet is force the commercials on the river to give up ownership, because the future spreads haven't really taken away their incentive to store. And what this move is doing is starting that. I've had multiple large commercial merchandisers tell me that in order for this situation to end with our shortfall in the West, we've got to extract ownership off the river. And you do that by destroying their economic carry capacity. So you've got to take these markets and you've got to invert them. So this is December to March. Here's December to May, which is at even. It's darn near inverted as well. And then here is December to July, which is trading in inverse. Now, if these markets continue to work higher and widen that inverse, then what we should see is a futures rally associated with that. And so I know that we're getting pushed around by headlines right in here, but remember, yesterday we were trading above this high before that stuff happened, and before the missile landed in Poland, and we were trading above this high and narrowing that spread and starting to invert these markets before these things occurred. So maybe we'll put the sidelines to bed and go back to trading those fundamentals, and the market will start to trade again and say, hey, an 8% stocks to use ratio is not loose. It is not ample supply. We are really tight, and we need to maintain premium in these markets. So I don't think that that the story is done in corn. I think we're going to continue to see some volatility, but these wave counts are really, really important. And yesterday's low has our full and undivided attention, and especially this low right here, and these lows right back in here. This range needs to hold in order for us to maintain a bullish bias. All right, now wheat. Wheat has taken out all of yesterday's premium. If you want to look at wheat from a few different perspectives, I think this is really interesting and telling. What we've seen here, if you put a line in through the middle of this channel, what you see is that we are trading on the top side of it, and that would imply higher prices to come. And so the relative risk reward here in wheat, as we've consolidated in this zone, the relative risk reward above 917 is bullish, because if it is to break this 992 level, then it counts all the way up here to 1180, which is an extreme risk reward scenario, and something that a speculator looks for very and longs for, right? You've basically got from today's low from 940 down to 916. So you've got about a 25-cent risk for a very nice risk rewards threshold. Of course, it won't go in a straight line, but that setup is ripe for that type of a move. I'm not saying that will happen, and certainly I understand that the headlines today are pushing us lower because, hey, Russia's got all the wheat in the world. We got way more than we need, and we've got and we've we're just going to give Russia access to it. So why do we need to work higher when we've got lots of supply? Well, don't forget that we've got the worst crop we've ever had here in the U.S. It's terrible. We got to have rain, and we've done nothing to alleviate the drought stress. Australia is being flooded out, and Argentina is is having massive problems with their wheat crop as well. So, absent the war, the fundamental analysis with corn with wheat is actually very, very bullish. And remember, bullish wheat is also bullish corn because they're cousins and because they work themselves into the food rations. So you'd like to see wheat and corn move together. And I think if those two move, beans move with them. I think they've all got to move together longer term. And the disjointedness where beans go up and corn goes down, or whatever, that disjointedness won't last forever, and it will revert back to norm at some point in time. So we've just got to stay with us and with the process and continue to identify those acute risk rewards, because that's going to help tell us what traders are talking about. Okay, I've been here 20 minutes. That's a lot of information, and I get that there's a lot of a lot of unknowns and a lot of volatility in these markets. So stay tuned. Watch your texts, watch your Facebook page, watch your emails, and we'll be trying to communicate with you as quickly as we can get information. Remember, there is risk trading futures and options, and you should only do so in light of your own financial condition. If you have questions or want to talk through something, please call us. We are happy to be available anytime. Have a great day. We will talk to you next week.